Hey guys, what's up? I'm Erin and welcome back to the channel. The credit score is undergoing some pretty big changes this year. The credit score in and of itself is a pretty big deal. It's the story of how you handle debt, and it helps lenders decide, do they want to do business with you and under what terms? At some point or another, the vast majority of us need to take on debt in some form or another. As much as I love the idea of being debt-free, the idea of buying a home or even a car for many Americans isn't possible without a loan, so you need your credit score. The fact of the matter is that over 90% of lenders use your credit score to make decisions about credit approvals, terms, and interest rates. The higher your credit score, the more likely you are to be approved for a loan and get better terms for that loan. For instance, if you're looking at getting a mortgage for $300,000, if you have a top tier score, that would entitle you to the lowest interest rates. And in this case, that's 5.1%. But if your score is in the 620 to 639 range, your interest rate would be roughly 6.7%. Your monthly payment would then be over $300 a month higher, meaning over the life of the loan, you would actually pay over $112,000 more in interest in the exact same loan amount. So your credit score matters, and while you can get approved for a mortgage without a credit score, it's not the most ideal approach because it makes the loan process more cumbersome and they levy heavier restrictions on your loan, like requiring a higher down payment. They could attach PMI to your loan even if you do have that 20% down already. They could require that you have a year's worth of mortgage payments in cash reserves. They could hold you to a more strict debt to income ratio. There's any number of things they could do, and the way I see it is, why make the process more complicated than it needs to be? Besides the obvious of getting approved for a loan, your credit score can actually influence your everyday life. Think about your insurances. Auto insurance, homeowners insurance, life insurance companies are even increasingly using credit checks as a part of their approval process. And your credit history and your credit score can end up influencing the rate you pay for these services. The four major cell service providers, AT&T, Sprint, T-Mobile, and Verizon, all pull credit scores for new customers who wish to pay for cell phones over time.
Can you hear me now?
If your credit score isn't up to snuff, you'll be answering no. Anytime you set up your utilities with a new company, think gas, electric, water, they run your credit score before turning on your services. And if your credit score is subpar, they may require a deposit before giving you new services. Even if you aren't buying a home, let's say you're just renting, property management companies run your credit score before approving you. So your credit score will determine if you are approved and what your security deposit will look like. And the biggie? Employment. Many employers will run your credit score before making a job offer or even a promotion within the same company. Now, of course, they can't just run your credit score without your knowledge. You do have to consent to it, but for many companies, it is a big factor. If you work for the government with any level of security clearance, they're gonna run your credit score. My husband is active duty and his employer can run his credit score on a fairly regular basis whenever he's up for a job promotion. And the important thing to note is that 55% of jobs paying $70,000 a year actually do run credit scores on their potential employees. So it's important to keep your credit score high because in the eyes of many employers, it's an indicator of your level of responsibility and your judgment over time. So let's take a quick look at the factors that affect your credit score. Your payment history makes up 35% of your credit score. Your payment history is the biggest component of your credit score. It looks at your ability to make on-time payments over time. And really, this is what lenders want to know. They want to know that you're going to pay them back and that you are going to pay them back on time. Even one missed payment can negatively impact your credit score. So you want to make sure all your bills are set up to auto pay so you never miss a payment. You don't have to worry about it. Credit utilization. This is just a fancy way of saying how much credit is available to you and how much of it are you using. And this category makes up 30% of your score. Now, you don't really want to use too much of your available credit, otherwise it can start to negatively impact your score. That threshold starts around the 30% usage rate. If you cross that threshold, that's where it can start to negatively impact your score. Let's say you have $10,000 of credit available to you. If you're using all $10,000, you become a little bit more risky in the eyes of lenders. You are fully extended. You may not be able to fully handle that amount of debt, or you certainly can't handle any more. So that's why your score takes a little bit of a hit. So it's best to keep your balances low whenever possible. It can even help to call and boost your credit limits on your credit cards, but you can't go spending more. That defeats the whole purpose. But boosting the amount of credit available to you while keeping your balances low can help to increase your credit score. Length of credit history. Generally, the longer your credit history, the higher your score, assuming you have good financial habits. The longer your credit history is, the more reliable it is. Because if you have 20 years of good financial behavior, that's more telling than simply 2 years of good financial behavior. So you don't want to go closing old credit cards. Even if you aren't using them, keep them open, because you want to keep that credit history as long as possible, because this category counts for 15% of your score. Have you heard of Experian Boost? This is not an ad, this is not sponsored in any way, but if you have a limited credit history, this is where Experian Boost may help. Because traditionally speaking, utilities, credit card payments, and streaming services are not reported to credit agencies. But if you go in and you hit that Experian Boost button, Experian will go into your bank account and look for on-time Netflix payments, and if you have a good history of it, you can get a little boost. Having a mixture of different types of debt can improve your score. This category accounts for 10% of your score. Having a mortgage, an auto loan, and credit cards can help paint a fuller picture for lenders, showing how you handle different types of debt over time. However, with that said, don't go taking on more different types of debt just for this category. It's still best to keep your debts as low as possible. And finally, new credit. This category looks at recent credit applications and new accounts and accounts for 10% of your score. Opening new accounts or simply applying to open new accounts can negatively impact your score. And if you have a lot of inquiries in a short amount of time, it can indicate that you're getting ready to take on a lot of debt, and debt is inherently risky. So of course, your score takes a bit of a ding. Now, the credit score isn't perfect. It's been under fire in the recent past for a variety of reasons, but nonetheless, it is the current system we have. But the good news is that some major changes have been implemented to the credit reporting and credit scores as of July 1st. First and foremost, major changes to medical debts. Medical debts under $500 will no longer be able to be reported to credit agencies. So they will not affect your score in any way, and this threshold limit is subject to increase in the future. Also, starting July 1st, the big three, Equifax, Experian, and TransUnion, will all begin removing fully paid medical debts that were once sent to collections. Prior to this reform, once medical debts were sent to collections, even once they were fully paid off, they remained in your credit history, permanently blemishing your credit history and negatively impacting your score. Now, the removal of these fully paid debts does only apply to medical debts, but it's a big move. This will affect millions of Americans. And that, along with setting that threshold amount that is able to be reported, is going to remove 70% of all medical related debt reports to these agencies. Americans collectively have roughly $88 billion on their credit reports in medical debt, meaning a lot of Americans are about to get a credit boost. In many ways, it's hard to call medical debt real debt. Few people choose to take on medical debt, and typically patients have no idea how much they will be charged for a service or a procedure. Having this type of debt prevent you from getting a job or a home seems unjust. I am actually super happy to see this change because you cannot foresee medical emergencies, and a lot of these medical services are very expensive. I myself had 4 surgeries and 6 procedures over a span of 8 months to get rid of a brain tumor. It resulted in several weeks in ICU stays and even more in regular hospital stays, and also hefty medical bills for the insurance company. Now, see, I was in a very blessed situation that I had phenomenal medical insurance, which meant my out-of-pocket expenses were never more than a couple $100. But I know not everyone is in that situation. Not everyone has that good of insurance. And the idea that that situation could prevent you from getting a job or a home or just generally moving on with your life is insane to me. Also, medical debts can no longer be reported to the credit bureaus until they are a year past due. Originally, that window was just 6 months. This is going to give patients a greater opportunity to negotiate those bills or perhaps even get them paid off prior to them ever going to collections. Buy now and pay later services are becoming more and more ubiquitous with online shopping. Most online retailers now offer them, and almost 60% of consumers have used them. These services allow you to pay for goods over a period of weeks or potentially even months, often without interest charges. So in that sense, they seem to beat credit cards, because if you're paying off something over a period of months on your credit card, you're inevitably going to have interest. Now, these buy now and pay later services are going to be reported to the credit agencies, whereas they never have been before. They are going to be categorized as short-term loans. So it's important to keep in mind that if you are repeatedly using this service, it's going to look like you have several short-term loans. Having a lot of short-term loans can actually bring down the average age of your account over time, and that can negatively impact your score. I still think it's best practice to only buy things that you can afford outright rather than paying for them over time, unless it's a big ticket item like a home. But if you need to be buying jeans over 5 weekly installments, you don't need to be buying jeans right now. FICO 10, the most recent version of the score, is going to look at your account balances and payments to your accounts over time. And your score will be reflective of your behavior trends in this area over a period of time, like 12 months or 24 months. Whereas preceding versions like FICO 8 and FICO 9, which still are the most widely used version of the score, simply look at a single snapshot in time of your credit history. But as FICO 10 becomes more widely used, scores will fluctuate, and whether your score goes up or down is going to depend on your behavior over time. For example, if you regularly max out your credit cards, even if you pay them off in full every single month, getting that balance down to zero, your credit score is likely to take a hit because of trending data. It will show a higher credit utilization over time. So it will become more important to be more responsible with your financial behaviors all the time. And arguably, this is a good improvement because it's going to show how your behavior trends over time rather than a single snapshot. Finally, worth noting, not a permanent change, but one that does hold through the end of 2022, every week you are able to get a free copy of your credit report at annualcreditreport.com. The pandemic was stressful on many people and their finances, and this is allowing people the opportunity to monitor their situation even closer. Traditionally, you only get one report per agency per year, but these weekly reports are going to be available through December 31st, 2022. So the way I see it, why not use this time to get your financial life in order? Yes, weekly reports might be a little bit overkill, but you can take advantage of more frequent reports while they are available, because why not? So what do you think of these changes to credit reporting and credit scores as of 2022? Let me know in the comments down below. I read every single one of them and reply to as many as I possibly can. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I hope you have a good one. I'll see you soon. Bye. Because it's a 20% down checks to determine for these insurances. No. Oh my gosh, they need to stop driving the trucks. What the frick? Debt-free? Under what terms? Actually starting, I don't like it. This service, are going to be reported to the credit negatively impact your score. That you don't want to use the word help. It's not helping. in time. So it's becoming, your Oscar is more important. Sucks. I don't know. Birdies. Oh, you're so cute. A bit more frequently. That was annoying. In several weeks, Experian, not Esperian, were sent to and be on credit. I don't think that's right. Peanut! Deposit. Pay them back. Your score. Didn't like it. To keep your score, credit boost. Oh my gosh, if you don't stop your car.